All right, now, the next part of this is extremely important because we have to kind of get our minds around what accrual accounting is and move away from our notion of cash accounting. All right, first of all, you have to use the accrual basis. You cannot use the cash basis of accounting. What is the cash basis of accounting? All of us are on a cash basis, right? Tax purposes, pretty much. There are some exceptions. What's a cash basis? We recognize revenue when we receive it in cash. We recognize expenses when we pay them in cash. Now, we do this every day, and our tax returns are run this way. What's the problem with using the cash basis for financial reporting? We have to use the accrual. We can't use the cash basis.
You may receive cash for some sort of sale, like it could be a year from now. It's hard to reflect that to people who are looking at for information.
Right. It doesn't measure economic activity. The cash basis does not measure economic activity. So, for instance, if you do a consulting job and you didn't get paid, but you worked on it from November through December, those 3 months, or those 2 months, November and December, those 2 months have economic value, and you are owed for those 2 months, so you would accrue the revenue even if you didn't collect it. If you incurred expenses that you didn't pay, cell phone bill, any type of utilities, rent that's due, you'd have to recognize that. Now, the other, you might think at the end of this program, we will find lots of ways that accrual accounting is not perfect. It's got lots of faults. But the cash basis, not only does it not measure economic activity, it can be easily manipulated by timing cash receipts and disbursements. So if you wanted to, you could hold back year-end billing to lower your revenue if you're on a cash basis. Send the bills on December 31st. This way you won't collect until 2017. And if you're on a cash basis, that revenue doesn't hit your income statement until 2017. So you can time them. Or if you wanted to, I don't know why you would do this on New Year's Eve, you can run to an Office Depot and go in there with lots of cash and just start spending and buying all these office supplies. And if you're on a cash basis, that's an expense, right? So, you actually can hit expenses on the 2016 income statement if you go out and spend money in cash on that last day of the year, even though those assets were not used up. So we have to use the accrual basis. That means that revenues are recognized when they are earned and expenses are recognized when they are incurred. You recognize revenue when they are earned, when the goods and services are provided. It means that economic activity has taken place. It will increase assets or reduce liabilities. Expenses, when they are incurred, when you have incurred an obligation to pay. Remember, when that liability is created, economically, you will reduce assets eventually, or you'll incur a liability. And of course, the activities will increase or decrease, and they will, the net assets of the company, which will say. Obviously, the net assets will change. Revenues will increase net assets, and liabilities, and by increasing assets or reducing liabilities, these will reduce net assets by reducing assets or increasing the liabilities. So, revenues are recognized when they're earned, regardless of when the cash is received. So, just to give you a couple of examples, and we'll stop after we go through these illustrations for revenues and expenses. All right, Target purchases inventories for May, $80,000, and it sells half during May for $140 in cash. How much did Target recognize in revenue? So their revenue in this case is only the amount of cash that they received. And in this case, they received 140, which is easy. But in the next case, they collected 130 during May, and customers promised to pay another 10,000 during June. And the question is, how much if Target collected 10,000, 30,000, and the same sale, they still sold the inventory for 140, they collected 130, and they have a receivable for 10. How much is the revenue? Still 140. So that even though they didn't collect the full amount of the sale, they still recognize the revenue. So in the first case, revenue was 140, and they collected 140. In the second case, revenue is 140, although they only collected the 130. So the key point is that the revenue is recognized when it was earned. It was earned when the goods were sold and delivered to the customer. Now, the expense side, and of course the customer has control over the good or service. On the expense side, it's the same story. Let's just make sure we understand it, and then we'll stop. Expenses are matched with the revenues. They're recognized in the period that the related revenues are generated regardless of when cash is paid. So Target buys inventories during May for $80,000. That's how much they paid in cash. It sold $70,000 of the inventory for $120,000. And how much is their cost of goods sold? Even though they paid $80,000 for inventory, their cost of goods sold is only $70,000. Right, so they only sold $70,000 worth of that inventory. So they have $10,000 left over. Their cash outflow, by the way, is $80,000, but their expenses are only $70,000. Their cash outflow. So I spend $80,000 for inventory. I use up $70,000. That's my expense. Not what I paid, but it's what I used up. And the same thing happens here. If they paid $60,000 for inventory, and they still sold $70,000, right? They still sold the $70,000. They paid $65,000 in cash for the inventory, and the other $15,000 is on credit. That still doesn't matter for the expenses. It's still $70,000. So it doesn't matter whether they paid cash of $70,000 or $80,000 and used up $70,000, or whether they paid cash of $65,000 and have a liability, the expenses are still $70,000. So it's a matter of the expense is the usage of the inventory, not how it was paid. It's either paid in cash or there's a liability, doesn't matter. So $70,000 represents the cost of goods sold. And it's based on the accrual basis, not the cash basis of accounting. All right, so now we'll pick this up, and I know I will definitely adjust the homework date. I don't mind going slow. So we're going to pick up from this balance sheet, and pick it up from here on the head. Just a couple of things, questions that I have either in the office or online, or in fact, somebody just asked you a question a few seconds ago. When we look at this balance sheet, the first thing you notice is that everything is current, so that your assets and liabilities plus equity, but the assets are all current, and the liabilities, that note payable, is also current. What it means is that the assets will be converted into cash or used up within 1 year operating cycle, whichever is longer. Liabilities will be paid within 1 year operating cycle, whichever is longer. So the question then was, the question I had right before we started this morning was, what's the relationship between the 12-month period, the fiscal year, the calendar year, and the operating cycle? Well, the fiscal year and the calendar year do not change. The operating cycle concept is only used to determine whether something's current or non-current. So your year end could be June 30th, your year end could be December 31st. That doesn't matter. If your assets are used up in a period of 1 year or less, then of course it's current within the 12-month period. If it's used up in a period greater than that, that becomes the operating cycle. So let me just again remind you what the operating cycle is. If I just get on here, and I'm here, I guess, right now. So good. So we got cash that you put into the business, and then you get credit, trade credit, which is accounts payable, and that's used to buy inventory, and then you sell it, which generates an accounts receivable, and then it's going to be back to cash again. Now, the first thing we do with the cash is we pay off the creditors. That's number one. And the second thing we do is we put the cash back in the cycle. Now, this cycle could take 2 weeks, it could take 2 months, it could take 24 months. So it really depends on the type of product. So if you take a company like Apple, Apple might have 5 to 6 cycles per year. So they have inventory, they sell it, they collect it back to cash again. So if they have 5 cycles per year, then current is what? 1 year, because it's whatever is longer. If you have a company that is, building aircraft like Boeing, Boeing may take 18 months to finish a project. Their operating cycle is 18 months. So the current assets are designated as such if they're used up within the 18-month period. But your question before we started was, what is Boeing's calendar year or fiscal year? It's still 12 months. So they report in 12-month increments, even though their operating cycle may be 18 months. So it's just a matter of the cycle we use to determine whether something's current or non-current. So as long as an asset is used up or consumed within 1 year or operating cycle, whichever is longer, that becomes the criteria for determining whether something is current or non-current. So I just wanted to be sure that was clear. It has nothing to do with your reporting period. It is solely based, or it's only used for determining whether something is a current asset or current liability, non-current asset, non-current liability. Has nothing at all to do with your fiscal year. Your year is still 12 months, even though your operating cycle could be 18 months. Any other questions on that? And any other questions you might have before we go back to the material? And another, we had Stephanie mentioned in the Wall Street Journal, I guess it was the New York Times over the weekend, there's an article that the FASB now issued a new standard, which we'll get to probably next semester, that will now make it more difficult for companies to avoid write-offs of bad loans or bad receivables. And I was mentioning that a lot of these standards are being issued this year. There's actually lots of new standards being issued within the last year or so, and it's mainly because, going back to what we said earlier, and as Bob Elliott mentioned, we talked about the social science aspect or this political aspect of accounting. When the economy's good, you can start issuing statements that will reduce income or have adverse effects on balance sheets and income statements. When the economy is in a recession, you're going to hold back on those types of standards. Those types of standards would have adverse effects on an already depressed balance sheet or an already depressed income statement. So standards, like right now you can see lots of standards hitting the codification that are based on reducing income. So now the new lease standard, that we'll talk about probably in intermediate 2, the new lease standard is going to substantially increase the amount of debt. So right now there's a lot of debt that doesn't show up for leasing, and that's going to change. So now all of a sudden balance sheets are going to explode with debt, and debt equity ratios are going to be adversely affected. And we couldn't do that 5, 6, 8 years ago because it would have such an adverse effect on an already depressed economy. So accounting standards tend to be issued based on whether or not companies can withstand the effect. So in a good economy, these income reducing standards tend to be issued. So just another application that you're going to be able to see. All right, but now back to the basics, and hopefully that operating cycle question was answered. So it is, the cycle has nothing to do with the fiscal year. As I said, Apple could be doing this 4 to 5 times a year, converting their inventory back to cash quickly. Could be 5 times a year, and their fiscal year is still 12 months. And it could end on June 30th, it could end on February 28th. That's up to the company. All right, so now, went through the balance sheet. Any questions about balance sheet transactions? And what we try to do is show you how the balance sheet transactions, of course, always keep this equation in balance. So very simply, if you sold, if you paid a bill, you would, reduce the liability, reduce the asset cash. So we went through lots of those transactions. And before I go to the income statement, any questions on the balance sheet transactions? Any questions on a balance sheet transaction? So what would happen if I bought inventory for cash? What would be the effect of purchasing inventory for cash?
Assets would go up and down, the cash would go up, I'm sorry, the cash would go down and inventory would go up.
Yeah, so inventory would go up and the asset cash would go down. Regardless of the amount, the effect is going to be zero, and of course it balances with the rest of the balance. What if I took that same inventory and decided that I wanted to use credit? What would it look like?
Liabilities go up?
Yeah, so inventory still goes up, but in this case, the accounts payable would go up as well. How do I pay off that liability? Anybody? Pay off the liability, yeah.
Cash goods and payable of service.
Right, so if I'm going to pay off this liability, cash goes down and the accounts payable. So those are the types of balance sheet transactions we look at. Looking at stockholders' equity now, what I've done here is just giving you, and one of the things we talked about this morning, I had somebody in the office a little earlier, and terminology, it's kind of something you have to keep up with. So in the stockholders' equity section, we've got contributed capital, which consists of common stock, preferred stock, additional paid-in capital, that we will build. Earned capital consists of retained earnings, and the retained earnings represents the earnings of the company that have not been paid out as dividends historically. So I started my business 40 years ago. Every time I have net income or a net loss or I pay out dividends, it accumulates in retained earnings. Other comprehensive income, we have to explain this a lot further, and we have to explain it many different times. That's something I'd ask you to hold off of right now. That represents really unrealized earnings, unrealized income. What I mean by unrealized is if you have holdings of stock today and the citizens of Great Britain decide to exit the European Union, tomorrow everyone expects that your portfolio will be down significantly. That's a loss. Your wealth went down, but if you didn't sell the stock, you don't have a realized loss. So unrealized gains and losses go into this other comprehensive income. And that, I want to leave it at that. And it's just something you have to think about over and over again, and it's not going to affect us for a while. So, but it's there because when you start looking at balance sheets, when we look at published financial statements, you're going to see it. So it's basically unrealized gains and losses. So as long as you don't sell your stock tomorrow, when the market starts to drop, you don't have a loss that's realized, but your wealth did drop. Your wealth did go down, but it's not realized. Unrealized. So looking back at this balance sheet, we looked at other transactions, and we know that contributed capital could be common stock, could be preferred stock, and then we have earned capital. So my last question on the balance sheet, just to be sure, and then I want to step back and see if you have any other questions on the balance sheet in the equation analysis. Remember, we're using these equations. The textbook calls it a financial statement template. It's important, and I'll show you where that importance comes in. It's a lot more important when we bring the income statement into play. But right now, I want to do one more transaction, and I'm going to ask you, how would you record the infusion of new capital if stockholders invested in an IPO or an additional offering of common stock? You issue new common stock. Anyway, what would happen? Andy?
I guess you have gain in cash.
Cash.
And gain in owner's equity.
Equity goes up. Yeah. Now, we're gonna have to be more specific. So for example, if, on the exam, for instance, everyone always worries about exams at some point, and I asked that question, it would have to be, well, equity goes up, but eventually you'd have to tell me whether it's common stock, preferred stock, whether there's a par value, whether there's an excess over par. Those details will come. So for now, if I issue new stock, I'm going to have an increase, let's just say, in common stock. And that's going to have to equal the increase in cash. So those are the balance sheet types of transactions we looked at. And that's how we built that balance sheet. We're using the equation as our initial recording device. It's our initial information system, and obviously we can't function that way. I mean, you're not going to be able to, you can imagine how impractical that equation would be if you had hundreds of thousands of transactions flowing through that equation. But for now, that's going to be our recording device. That's our information system. Now, before I go to the income statement, I need anyone who has any questions about the balance sheet equation to ask now before you refer. Yes?
So for when you buy inventory for cash, both transactions happen on the asset side.
Right.
Can you give us an instance where both transactions will happen on the liability and equity side?
Liability equity side?
There's a couple of questions on the homework that threw me off.
Yeah.
That they both happened on that side.
Yeah. All right, first, now these are a little bit more, a notch up in terms of sophistication, but dividends. Dividends you don't pay. So what if I declare a dividend right now? Where do dividends come out of? Dividends going to reduce what account? Retained earnings. So if I have a dividend, it's going to reduce equity, and I'm going to increase dividends paid if I don't pay the dividend. And that has no effect on the assets. The other is, again, we're notching it up in terms of sophistication. What about a convertible bond that converts to common stock? On the day it converts, what happens? You've got a bond that you can now trade in and get common stock. So what would happen?
You would increase the cash and increase the common stock, or like
You would
equity capital?
increase the common stock, and you would.
Increase.
You're holding a bond as an investment. You now swap it for common stock. So common stock goes up, the debt goes down. Because you're handing in, like you're taking the debt, swapping it for common. So if you have a conversion, the debt is going to go down. So let's say it's a bond payable, and common stock goes up. So what the company's doing is they're saying, all right, I'll take your bonds back. I don't owe you that money anymore. I'm going to pay you off with common stock.
So when you initially bought the bond, so you added, so it increased liabilities of bonds payable.
Yeah.
And then would that have decreased cash?
Yes.
At that
So
point,
what would
okay.
happen
And then when
on
it
the day you
converts-
issue the bonds? It's a good question. Bonds payable go up and cash goes up. So you borrow money. Now, I'm going to be, and one of the things that we think about when we do, when you go into finance, I mean, we're going to, we're moving a little bit, as I said, a little further along the line here, but when I issue debt, I borrow money. So cash goes up and bonds payable go up. I can pay you off with stock instead of cash. It's a good deal for the company, right? So if I know that you have the option to convert, if my common stock goes up, you're going to convert. And if you convert, that's what happens. Let me answer your question, Scott. That's what you can do. As I said, you got to go.
Yeah.
You got to bump it up a little bit in terms of like business knowledge, but definitely things like that could happen. All right. Any other questions on the balance sheet side? Balance sheet side is the easier of the two. But are there any questions before we go any further? let's have the approach. We're recording transactions. And you notice I was asking lots of questions about the cash flow effects, and I'll continue to do it. Now, we have to bring in and introduce income statement. Income statement transactions. So the income statement is simply revenues minus expenses. It's over a period of time. It's the flow of wealth. By the way, again, the balance sheet is a stock of wealth. It's a static statement. So let's get started with some of these transactions. I want you to stop me at any point. If there's anything you don't understand, or if you want to add something, that's fine. By the way, this is, as I said, very much like my experience in corporate training. You're sitting in a room with people that have seen this 1,000 times, and people that have never seen it before. So if a question comes up, I will answer the question if someone has some experience. If it's, I'll let you know. If, as I just said before, it's a great question, a little bit off of or above where we want to be. So just let's make sure we focus on the basics, but I will entertain questions if you have them, if it goes beyond what we need to know for the course. All right, so let's go right to the income statement transactions. So now we're going to record income statement. All right, so now you have a business, you're going to advertise in a local newspaper, and you're paying $900 for advertising. So the first thing I want to do is remind you that when we record expenses, it's going to have a dual effect on the equation. So the first thing we want to do, and by the way, when we pay cash here, yes. So of course, there's a cash outflow minus 900. And then on the expense side, expenses go up. Let me make that clear. Advertising expense. Right? So here is point of confusion, common confusion number one. When expenses go up, they reduce income. So you have to remember that will reduce income. And as I was explaining it this morning, it's, just think about it, you have to keep track of how much you're spending, and you have to be very specific with respect to the account that you're accumulating that in. So if this is advertising, you want to know how much you're spending on advertising. On exams, if you just put down expenses, not good enough, because you're going to have to explain to somebody at some point how much you spent and where you spent it. Right? You have a budget. You have to account to someone. You can't, have a meeting with a supervisor and they look at your budget and say, well, you spent $900 and it just says expense. The next question is, what kind of expense? What was it for? Why did you spend that money? So you have to be very careful with respect to the expenses. Okay, so the expense goes up, but of course that reduces income. Now, that is the primary effect. By the way, what's the cash flow? How would you classify that cash flow? Is it operating, investing, or financing? Advertising.
Operating.
It's operating. It's part of your operation, so it's an operating cash outflow. Now, here is the major link that you have to keep in mind. This is a critical link. Now, you don't, when you're recording this, as I said, one thing I like about the book is going to keep you always focused on the financial statement effects. So yeah, you will know the bookkeeping. You have to know bookkeeping. It's a fundamental. But you will also know the impact on the financial statements. Anytime you have an expense, and these are the secondary links, it will reduce net income, and that will reduce retained earnings. So anytime you have an expense, it's going to reduce net income, and it's going to reduce retained earnings. Those are the secondary effects, and it's a smiley face because you have to know that, I guess. But those are the secondary effects. If you were making a journal entry in this company's books, you would only increase the expense and reduce cash. You would not, at this point, do anything with retained earnings or net income. Those are secondary calculations. So, let me see if I can make this as clear as possible. The only entries that you would make, and I know they're using different colors there as well. The blue is what you record, and the black is the secondary, but I thought I would do it with you step by step so that you don't record this. This is not recorded. These are the effects of the on the financials. You would simply increase advertising expense, and you would reduce cash. Now, when you walk away from that transaction, what you have to remember is, okay, I got an expense, that's going to reduce my income, and that's going to reduce my wealth. You would not make 4 entries in reality on a set of financial statements. You would not have anything but an increase in advertising expense and a reduction of cash. Now, this is the first one we're looking at. Let's talk about it. Does anyone need a different explanation? Does that bother anybody? The fact that you have to not only make the entry, reducing cash and increasing that expense, but you also have to walk away from that transaction understanding that that will reduce net income and it will reduce retained earnings as secondary effects. The primary effect for us is to make that entry. The secondary effect is the impact on the financial statements. And you'll notice a lot of the homework is asking you to kind of spin around these statements, backing into numbers, and that's how you build your understanding. If you're going to do anything in accounting, once you get past the bookkeeping, when I say you walk away from the bookkeeping, you've got to think about how to analyze the transaction. How does it affect the company's financial statements? And that's what we're trying to do. We're trying to build that understanding now. So yes, you've got to know the bookkeeping. It's critical. But beyond the bookkeeping is where you start thinking like an accountant. You start thinking like a business person. What is the effect? And you're going to do that on your own. It's not something that you would just do in an accounting course. You're going to know that, hey, if I spend that much in cash, I'm going to lose that much of my overall wealth. My net worth is going to drop. All right? If I have those kinds of expenses, if I take that kind of a hit in an expense, it's going to not only reduce cash, but it's going to reduce my overall income, and it's going to reduce my overall wealth. So that's the logic in this transaction. So we're going to do more, but any questions on this one? Okay. All right, so let's clean that up. Get the next one coming in. Let's go to the next one. And the next one is going to be, you're going to pay for inventory that you previously purchased. Now, the reason why this transaction is kind of put into the income statement portion is for the following reason. You're paying for inventory that you already purchased. Is that an expense? Not yet, because you didn't use it. So in this case, we're back to where we started earlier this morning, and that is, we're simply paying off accounts payable. So this now becomes a balance sheet transaction. I'll tell you why it's there in a minute. So the cash goes down by 15. And the transaction before created a liability, so we're going to reduce that accounts payable. Cash outflow, this is operating. That's an operating cash flow. That is an operating cash flow. Yeah, we'll leave that there. Let's go to the next one. Unless you have any questions on that. Everyone seems to be pretty good at the balance sheet, so. Now, here is where we get a little bit tricky. We've got a sale of inventory to customers for $2,400, and that now used up $600 of inventory. It used up $600 of inventory. So let's start with transactions. The first one is going to be the sales. So let's forget about the secondary effects for now. have sales revenue going up by 2,400, and you have cash, of course. There we go. Cash. That's also an operating cash flow. Let's forget the secondary effects for a moment. That revenue was generated by selling off inventory of 600. So also on the asset side, you're going to have a reduction of inventory. And you're going to have an expense that we call the cost of goods sold. And actually, I'm going to move that down, keep those separate. So you have a reduction of income by increasing an expense. Now, here's the typical question. There's no cash effect here. Why? Because you already paid for the inventory in the previous transaction. That's why this transaction is here. So you paid for the inventory before, but until you use it up, it is not an expense. So let me say that again. You could spend, and again, we're not on a cash basis, we're on this accrual basis of accounting. Recognize revenues when they're earned, regardless of when they're collected. Recognize expenses when they're incurred, regardless of when they're paid. So this inventory was paid for in the prior transaction. That could have been last year. But you paid for the inventory in the prior transaction, and now you use it up. When you use the inventory up, it then becomes an expense. Only when it's used. Until it's used, it's an asset, because it has future economic benefit. We define assets, and by the way, all these definitions are important, because in some cases, you may not have an asset that's all that obvious, and you may have to apply a lot of that conceptual framework to determine whether or not, in fact, an asset exists. So, in this case, the inventory has been paid in a prior period. Now, the secondary effects, which as I say here, they're, I'm not going to worry about the colors they're using, but a couple of things happen. If your revenue goes up, then your income goes up, and so does your retained earnings. If your expenses go up, your income goes down, and so does your retained earnings. And of course, those are, as I said, the links that we have to keep in mind between the balance sheet and the income statement. And there's one more important point here that I'll get to. And then I'll ask a question. Here's that point. The only way the balance sheet can balance here is if we take into account the effects on retained earnings. So sales revenue balances with the increase in cash. The cost of goods sold balances with the inventory reduction, but only when it is transferred or closed or reflected in retained earnings. So unless you reflect the revenue in retained earnings, unless you reflect the expenses in retained earnings, the balance sheet will not balance. So you have to move those effects somehow into the equity section. But as I said, right now, we're just showing you the effects. We will actually give you the mechanical impact, journal entries and things like that as we get. So when you buy inventory, whether it's for cash or on credit, until it's used, it is not an expense. when it is used, when it's sold, when it's used up in supplies, used up in production, it becomes part of your expenses here, for example. And again, secondary effects, revenues increase income, increase retained earnings, expenses reduce income, reduce retained earnings. When you understand the effect on retained earnings, that's how the balance sheet will balance. Remember before, the question I had before about the two effects on equity or two effects on liabilities and equity, notice what happens if you don't make this transfer, either mentally or formally, which we will, but like intellectually, if you don't make the transfer of revenues into retained earnings and expenses into retained earnings, the balance sheet can't balance. Balance sheet can't balance unless you have a transfer of the revenue and expense effects into retained earnings. Now, we're not doing that formally yet with entries or journal entries, but questions at this point. Anyone have any questions, want a different explanation, want to take a look at, we're going to take a look at another transaction in a second, but anything else on this? Yeah.
So the only thing I'm curious about is I don't know if I'm jumping ahead here, but we go
That's it,
into
yeah. It's okay.
the accrual accounting aspect.
Yes.
So you're accruing expenses and you're accruing revenue.
Right.
So when I accrue revenue, does that immediately go over into the earned capital? Or
Yes.
do I wait until?
No, as soon as revenue is earned, it goes into the earned capital. It goes into retained earnings immediately, whether you collected it or not. So very similar, we're going to see some examples of that. But similarly, I mean, let's assume, let me just get rid of this transaction for a second. So let's say I didn't pay for this inventory yet. Got to record the expense. So it has nothing to do with the cash.
So if I was an investor and was looking at the retained earnings, I just have to be kind of skeptical because that's not necessarily the case that you collected on all that, right?
Right, yeah, so,
Got it.
right, that's why we have the cash flow statement. So for instance, if I never paid for this inventory, there's no cash effect. The cost of goods sold right here has no cash effect. So we will get to the cash flow statement that answers that question. But what the cash flow statement does not do is measure economic activity.
Okay.
So right now, this company's economic activity is revenues of $2,400 and expenses of $6. If I was on a cash basis, I'd only show revenues of $2,400. I would be misstating, I'd be overstating income. Because if I just base it on cash flow, it doesn't measure the economic activity. Economically, I used up a resource that even though it didn't affect cash at this point, it's going to impact my earnings.
So at this point in the course, like a better way maybe to find a balance sheet is kind of like a snapshot of economic activity.
Yeah. Yeah, I mean, some textbooks will tell you, you'll hear that the balance sheet is a snapshot and the income statement is a motion picture. It's a moving flow.
I guess where I get confused, I feel like I can pick up things about the economic activity on the income statement, but technically, because if I'm selling something, I'm
Right.
using.
And that's where you pick, that is correct, that's where the economic activities reflect. But I was just saying that if you wanted to look at this from a cash basis,
Got it, okay.
you only have revenue. You have no expenses.
Okay.
Yes.
And maybe I'm a little confused, but you just said we have to, when there's revenue and expense, put it in retained earnings immediately? Because don't we wait till we close the
Yeah,
income
well,
and expense accounts?
that is absolutely true from the standpoint of a manual bookkeeping approach, which we'll show you. So we're going to assume that everything's going to be taking place in a manual way, so that you have the transactions throughout the month, and then you close that month out. So it's as if you don't have any information until you close the books, and that's not actually the way, first of all, the way we should be thinking, and secondly, it's not the way it would happen with, even if you had something like QuickBooks, you could just press a button and your retained earnings is already reflecting the impact of those transactions. But there is a formal closing process which we'll look at. But from our standpoint, as individuals that are going to be working in accounting, whether we do like yesterday we talked about some finance aspects, of what we can do with the accounting, information, we have to keep thinking about the overall impact. It's a much broader impact than just, this effect of revenues and cash. We have a cash effect, we have a revenue effect, but we also have an effect on retained earnings. We also have an effect on overall capital, overall wealth of the company. But you're absolutely right. From a pure textbook approach, it's going to be one step at a time. And the closing process takes place at the end of the accounting cycle, not the cash business cycle we have, but the accounting cycle. Okay. All right. Any other questions on this transaction? Yeah.
I don't know if this is like relevant, but like, what if we sold the $600 of energy drinks that we bought on credit?
Right.
So would this have effect on cash yet? Because like,
No.
because our liabilities would be
Yeah, I
the
mean,
accounts
I might
payable
have-
for the 600.
Yeah, probably
Okay.
back in the other part of this example, we had an increase in inventory of 1,005, and we had an increase in liabilities of 1,005. Now, the example before this, or the transaction before this, I showed you paying it just to let you know the cash took place before we actually used up the. But let's say I never paid it. It doesn't matter. This is still an expense and it's still using it, even though I didn't pay it. So the idea is when you use up an asset, that's a definition of an expense. Or if you increase a liability, I mean, it's possible. I'll show you that in a minute. But here, it's asset utilization that's being consumed. This, in other words, out of this $1,500 of inventory, 600 of it has no future benefit at this point. It's completely expired. It has no future benefit to the company. All right, anything else on this transaction? I want to spend as much time on these as possible. The income statement does get a little bit more tricky. All right, let's do the next one. And this time, we're going to do the same thing. We're selling inventory. So let me. Let me clean this up and get this out of the way. All right, so it said we now sell $700 of this inventory, this time on account for $2,900. So once again, it's a sale transaction, but here's the difference. In this case, we're going to have sales revenue, and that's going to be for $2,900. So up here on the revenue side, and we're going to forget about the secondary effects for a moment. In this case, the asset is accounts receivable. There's no cash flow in this case. So you have revenue, for getting back to your point, here you have revenue without cash flow. So I'm measuring economic activity. Now, again, I know the first day when we hear you mention, oh, wait a minute, we will take into account the probable collectability of those receivables. So we will, in fact, analyze receivables. We'll get to that in chapter 6 or something like that. Okay. And we'll show you that there are techniques that we use. We look at past history. We're going to look at collection patterns. We'll look at the individual company's financial condition. We'll look at economic conditions, industry factors to determine whether or not that full $2,900 is collectible. So right now, assuming no impediments to collecting that, it'll show up as an asset with future economic benefit valued at $2,900, and the revenue, in fact, will be reflected as the economic activity. And then, of course, the expenses, let me bring that up on the screen. The expenses are $700, and that's going to be the cost of goods sold. So you reduce inventory as the inventory is expired, and you also have the cost of goods sold of 700. Now, to take this one step further, stopping right here, notice that revenue is recognized even though we didn't collect it, and those expenses were not paid. We don't know if they were paid. So you've got the cost of goods sold, no cash flow effect. You've got the revenue effect, no cash. But once again, the secondary impact here that's important is that the revenues increase net income, the expenses reduce net income, and again, balance the balance sheet. Okay, so revenues have to balance, and I can put the numbers in, I know you see them there. And if I had to stop right now and look at that company's income statement, their net income is net income's 2,200. What's their cash flow? Nothing. Got no cash, but you're going to show income of 2,200. Now, that gets explained on a statement of cash flow, so don't worry. I mean, it's going to be transparent. So once again, from the bookkeeping side, you will increase accounts receivable, increase sales revenue. You're going to reduce inventory and reduce cost of goods sold. But you have to know that that revenue increases income, those expenses reduce income, and the effects on retained earnings are to increase retained earnings by revenues and reduce retained earnings by expenses. So now, here is a good example of a non-cash event. Both of them are non-cash events at this point. So let's take some questions. Anyone with any questions at all on that last series of transactions? And again, if I had this built up, you would see how the statements are starting to form, but we will get to it. Anyone with any questions? Everyone fine with this? Anyone want to see something else, or raise any other questions on anything that you got on the equation? Yeah.
So in their operating cycle, at some point, those accounts receivable will turn over into a cash asset?
That's right.
Okay, so.
Yeah, that's the whole issue now. I mean, if you look at it, if you go back to the cycle, in the cash operating cycle, the problem is that if you don't, all right, so now your inventory is reduced. We did record the sale. All right, so in this case, we used up 700 in inventory, and we recorded 2,900 in sales. But the problem is, unless we collect those receivables, cash is zero. And if you don't have the cash, you're not going to be able to pay off your accounts payable.
Okay, so a company like Boeing is always going to have a lot of non-cash assets because of the receivables. They're waiting.
Yeah, assuming on one project. So let's say take one project at a time.
Okay,
So now they're building this new jet, and they're kind of like stuck in the inventory
right.
side. They haven't even sold it yet. Right, so this is a good question, because if you think about an operating cycle, any significant delays here, holding too much inventory, or any delays here, collecting, could cause a liquidity problem in a company. And we'll do more and more of that. So you're right, it's a little bit ahead, but it's exactly on point, because we're showing you that, yeah, you're moving inventory, you're generating receivables, but you're not collecting it at this point.
Yeah, because the only reason why I ask is
No, it's good. You're right.
once you understand the bookkeeping aspect,
Right.
then you kind of see like how they get to these values.
Exactly right.
Yeah.
You got to go to the bookkeeping first.
Yeah.
Exactly. And then one, as I said, then move away from it and make sure you could do both at some point. We're doing the bookkeeping first, but I want to make sure you keep that in mind as well. You're absolutely right. So the bookkeeping side will show you that you got the receivables and inventory change, you got the net income side of it, but then we'll think more about cash. We'll get to the analytics as well eventually. All right, so let's just think about one other thing here, to answer your question about the Boeing cycle. Don't forget, they've got a project that they're building a jet right now. That is now tying up inventory, it's tying up cash, but while they're doing that, what keeps them in business is the resolution of other projects and the collection of other projects.
So they kind of have a pipeline of
It's a
projects.
pipeline, or it's kind of a rollover effect. You know, one project kind of spills into another. Same thing with construction. So as you're collecting on one construction project, you're starting another.
Okay, so that's how they get the cash flow.
That's how you get the cash
Okay.
flow. So eventually, obviously, the receivables get converted back to cash. The inventory gets converted to a receivable, unless you sell it in cash, and then
Of course.
receivable is collected. Okay. All right, so any other questions on this transaction? So now, we have wages, they're gonna pay wages, and these are wages that were incurred during the month of May. This is not wages that were, these are not wages that were accrued, they were, new wages, so it's all gonna be a cash transaction. Okay. So in this case, again, this is the cash effect. And in this case, we've got the wages increasing. Of course, that reduces income and retained earnings. And that's coming right out of cash. So you have a reduction of cash, and you have the wage expense increase. Now, of course, again, expenses reduce net income, and they reduce retained earnings. In this case, it's an operating cash flow, an outflow up from operations, because wages are needed to operate the business, so it's an operating cash flow. Questions on that transaction? Yes?
So before I paid the wages, it would just be in accounts payable?
If you didn't pay it, if you just accrued the wages,
Yeah.
yeah, you would have, the wage expense is still the same. So let's do that in a second, but the wage expense would be the same, but instead of having the cash outflow, you'd have an inflow or an increase in payable. All right. Any other questions? Because I will get to that in just a second. All right, so here we go. I like the question because, once again, whether or not you paid it in cash. Now, this is not our transaction. If we didn't pay those wages, they would be accrued without cash flow. And notice again, the balancing effect is that, and we mentioned this closing idea, so the wages reduce income and they also reduce retained earnings. And that's how, again, that's how the balance sheet balances in that case. Right, wage expense going up, reducing retained earnings, wages payable go up, increasing liabilities. It zeroes out on the equity side and liability side, and no effect on assets. In that example. Just to take that question a step further. All right. Anything else on the wages? All right, now, the next one may be a little tricky, but let me make sure. Everyone okay with this? I don't want to go any further, so anyone have any other questions on this last transaction and the extension, moving into a payment? So let's go to the next one. Next one, as I said, maybe going to raise a little bit more discussion. We now have a payment in advance for a subscription to buy online products. For June, July, and August, you collect it in May. So if we map this transaction out, and let's take a look at the way it might appear. So on May 1st, you collect $300. Basically, you owe somebody 3 months service. You owe someone 3 months service, membership. You have cash of $300 in May. How much income do you have?
Right, for what period, like?
During May 1st, May 31st, at that point.
No.
100?
None. In June, you owe someone service for June, July, and August. So basically, at this point, you have cash, but you have no revenue. Revenue is earned as the service is provided. So here you've earned 100. And you earn 100 every month. So basically, what you have at this point we change the color there. At this point, you have cash of 300 and you have a liability of 300. But you have no revenue. There's no revenue earned at that point. So you have cash of 300 and you have a liability of 300, but you have no income at that point. Because you still owe them the service or the goods. Now, one last point before we put this up on the screen, and that is, what happens when June is finished? You have $100 of income. How much is your liability? 200, right. So at this point, liability is 200. After you provide the service in July, how much is your liability? 100. And at the end of August, you've paid off the liability. So I want you to see the flow, and these are extremely important cutoffs. I mean, this is really what makes account. We'll see a lot more of this. I mean, we're not going to end this today with respect to bookkeeping, with respect to looking at these effects. We're just getting started, really. But starting to pick up this idea that accounting has to show the effects of transactions within the periods that we create. So if we're reporting monthly, we'd have at the end of June income of 100 and a liability of 2 if we're reporting monthly. If we were reporting annually, you'd have income of 300 and no liability at the end of that period. So it depends on when we're reporting. It depends on when we're reporting. All right, so now, how do you record the transaction? Unless there are questions on the movement of that information. How do we record the transaction? It's going to be cash and a liability, which is called unearned revenue. So in this case, unearned revenue. And of course, the interesting point, terminology is kind of weird. How could you have an unearned? How could you have an unearned earning or an unrevenue revenue in a sense, right? But that's what we call it. It is more of an advanced collection, if you like. So that advanced collection is a liability that you have to provide the service. And this is true whether you collect in advance for membership fees in a health club, whether you collect subscriptions for a periodical, an online periodical, whether you collect subscriptions for deliveries of a product. You might pay upfront to get products delivered. It is a liability that gets paid off by delivering the good or service. This is where you pay off a liability without using cash.
Would gift card sales also be something
Yeah,
similar?
gift cards are the same thing because you now owe the person with the gift card the right to buy to take products or services from your establishment.
And then when that's fulfilled, that becomes revenue.
When the liability is satisfied, it
Satisfied,
becomes
okay.
revenue. So if you look at the diagram in the black, that's when you have, after you provide the service that month, you have earnings of 100 and you've got liabilities of 200. So to show you how this would work, by the way, notice you have no revenue, but you've got cash. Now, in this case, let's talk about the economic activity. It's a perfect example. What we're saying to you is to make sure you understand that your client could have cash, but I've done nothing. And therefore, it is a non-revenue, and you can't really boost the revenues for not providing service. Let me follow up on your question. Looking at the diagram, let's say in the month of June, what would happen? And again, this is taking it a little bit further, but it's good. This is exactly what I want to do. We'll get to transactions like this. You'll see these, believe me, you'll be sick of seeing the same thing over. Let's just go through that. What happens in June? In June, what will occur is that you will now be able to recognize 100 of revenue earned, and you're going to reduce the unearned revenue. And at that point, the liability is at 200. Just as a side note, but revenue's earned, but now there's no cash. You already collected the cash. So we have to try to measure, this is a very important aspect of accounting, we have to allocate transactions to different periods. It's really a measurement issue of when you recognize the transaction. So to take your question, that's the way it would be.
Excuse me. Professor Sannella,
Yeah.
does cash go down with each allocation period?
Cash?
Yeah.
No, cash is, you've collected, this cash is collected, so that's it. It's in the bank, you might have spent it already.
Okay,
I mean, we don't know what you spent it on. It has nothing to do with this transaction. I mean, you theoretically, you should have used that cash to support your operation so that you can deliver the products and services. So in this case, you're paying a liability. You're paying a liability with what? Goods and services. That cash may not be around. I don't know where it is, but you owe me a product.
So I understand how for June, revenue earned goes up and you subtract liability, but now the balance sheet doesn't.
Yeah, well, because I did forget the last, got the link, because this will now increase net income and it'll increase retained earnings. Sorry. So I forgot what you're not supposed to forget. Don't ever forget. Yeah, so that's exactly right. Balance sheet will balance through the closing process or the transfer or the articulation process. All right, right, so we're still moving along, but this is a good example. I like the questions, and just keep asking them, because these are, brings up lots of other things. Sometimes a question that you might think is simple or is not the right question to ask will kind of allow us to really discuss it and answer more questions. The cash is someplace, but that's not my responsibility right now. You don't have to worry about where the cash is, as long as I have enough product and service to provide you. Even as a consultant, if you collect up front, a retainer, a legal, right? Lawyers have retainers, or accountants would have a retainer. You owe them that service. You pay somebody up front, they owe you the service. All right. Anything else on this transaction? All right, now we're going to go to a simple one, I think. Just collecting from customers. And again, this is where the accounts receivable gets collected. Okay, so it's pretty simple in this case. We've got cash goes up, accounts receivable goes down. 1,200, I think it is, right? Yep. And there's no effect on the other side of the equation. Operating cash flow without income. Income was already recognized when you sold the product. So back to the question of the operating cycle. It's at this point, it's like collecting some of this receivable now. All right, so now you got the cash coming in on that cycle. All right, so again, not to minimize this at all. I know we've seen it, but do you have any questions? Now remember, it's not revenue, even though you collected it, because you've already recognized it. All right, a few more to go. Let's take another one, unless you have anything else on this one. All right, next transaction is you are paying off interest and principal on a loan. This is kind of a combined transaction, a compound entry. In this case, you're paying off both principal and interest on a loan. Now, a couple of things that happen. Number one, you've got total cash outflow of $4,040. So you're going to have a total cash outflow of $4,040. Of that amount, $4,000 pays the liability, and of course the $40 is for the interest. So let's just take a look at the. In fact, by the way, I'm sort of doing this a little differently. The way I like, as I said, I've used these equations for a long time. The way I like to do it is to actually put the net income here, so you can see the link a lot better. The way they have it in the book, the net income is way out on the right side. It looks like it's a remove from the earned capital, but it's really important. So in this case, cash goes down by $4,040. Of that amount, the note payable goes down by 4. And here, interest expense, even though it goes up by 40. And then, of course, that will reduce net income by 40 and reduce retained earnings by 40. And that's how the balance sheet balances. You have minus 440 on assets, minus 4,040 in liabilities and stockholders' equity. The interest expense is going to be increasing expenses, which reduces net income, which reduces retained earnings. Now, of course, there is a little bit of a complication here with respect to cash flow, but for the most part, we're gonna tweak the $40 effect, whether it's operating or financing, depending on whether we have US GAAP or IFRS. But I would say right now, you can think of this as all financing for now. For now. In some cases, you may think of interest expense as an operating cash flow. But let's treat it as a financing cash flow for today. Can anyone, by the way, think of a reason why it might be an operating cash flow? Why would interest be an operating cash flow? Let's go back to the cycle here. Well, let's go back to the example we had before. Let's say you didn't collect. What if you didn't collect in this cycle? How would you pay off your liabilities? What if you didn't collect in that cycle? Accounts payable are due. How would you pay them off? What would you need to do? Got to borrow. Got to borrow on a short-term note. And that short-term note's going to generate interest, part of your cycle. So in many cases, we could argue that interest on short-term loans, and actually all interest, could be part of operations. And that's how we make that argument.
How would you record the interest if it's based on a percentage?
If it's based on?
If it's based on a percentage, or do you have to record that exact number for the interest?
Oh, you mean if it's accrued over time?
Yeah.
Yeah, you would have to allocate it based on, for example, if this interest was, for 1 month's interest, every month you would have to make the same entry.
Oh.
So it depends on how the interest is accrued.
Okay.
This assumes you pay the interest only at the end. That's a good question. Yeah, you'd have to allocate that out as well. So that's the argument for treating interest as an operating outflow. Because, we talked about this. If you worked in commercial bank, in any commercial banking application, you have what is, I think I mentioned this, you have what is known as an asset-based loan. And asset-based lending is basically lines of credit that you will get for your operations. And what are the assets that are being held as collateral? Inventory and receivables. So the bank will look at your receivables and inventory and determine how much of a line of credit they'll give you to cover situations just like this. If you don't have cash payable to due, you got to draw on that line of credit. It's almost like like I said, like your credit card has a, when you first get one, I think, what's the line of credit, $500 or something? That's a line of credit. And you could always use that for emergency situations, and that's what banks will do. They will give you a standing line of credit, and that standing line of credit is going to be used to cover situations where you don't collect in time to pay off your liability. And typically, it's an asset-based loan where the inventory and the receivables become collateral. All right. 2 more transactions. Now you paid insurance, or prepaid insurance, I should say, for a 4-month period. In this case, you have an asset. And why is that an asset? That's an asset because it has future economic benefit for a 4-month period. So that is an advance payment, or a payment you make in advance. So what happens here? You have prepaid insurance. Cash goes down for $800. Prepaid insurance goes up for $800. And there's no effect on the other side of the equation. No effect on the income statement. That is a pure balance sheet transaction. It is a prepayment of an expense. It is not an expense at this point because it hasn't been used up. So let's go back to sort of a timeline model that we had. I know we did this for the revenues, so we could do the same thing for expenses. So if we take timeline, and we have, and this was, we paid this in May, I think. Didn't say when, but okay, so we've got 4 months. We paid this in May, and that's 800. So we have an outflow of $800 in May, which is a little larger, and I'll come back in a minute. So that in May, we know we have no expense, and we have an asset. It's the cash paid. Okay, so you have an asset of 800, and you have no expense at this point. Now let's assume we're reporting monthly. We'll assume that we're reporting monthly. All right, so what happens? Let's go to June. In the month of June, you have insurance coverage for 1 month. You've used up 1/4 of that asset. So how much is the expense in June?
200.
It's 200, right? Yeah. So your expense now is 200, and the asset is now 600. In July, you use up another 1/4, another 25% of that asset. Expense,
Yeah.
200, asset is 400. And I'll put it up on the equation in a minute. And of course, August, 200 in expense, asset is 200. And finally, in September, as we use up the insurance, at the end of September, the asset is 0, and we still have an expense of 200. So we have an expense every month of 200, and the asset gets amortized, it gets written down, it gets used up. Now on the equation, if I go over to the equation, maybe for just 1 month, prepaid insurance is going to go down. We're going to have insurance expense on the other side. We're going to increase insurance expense. 200, of course, that's going to reduce net income and reduce retained earnings. I should have it lower, but there's the balance. And then if you were using this as a reporting device, you're going to have your 600 here. There's your balance. So we're allocating expense. You know, again, if we were using cash accounting, as soon as you spent the 800, it would have been an expense. If we were using cash accounting. By using the accrual basis, we measure the fact, number one, you got an asset, and that asset has 4 months of life, and as every month passes, you use up 1/4, recognizing the expense, and the asset decline has to be recognized. And that is the process of really converting this asset into an expense. All right. Any questions on that? So you saw the prepaid expense here. We saw the advance collection before. this is starting to give you really a good exposure to what most accounting transactions will entail. You know, straight up transactions are straightforward, obviously. When we look at this more in detail, you'll see that it takes some thought, not a lot. You know, as I said, the toughest thing accountants do is divide, so we don't have to worry too much about math, but we just have to think about the economic effects as we go. Yep.
What if I pay for my insurance with like a credit card or something like that?
Yeah.
So it would go into the liability section. It would be amortized basically the same way. Is that right?
Well, as you pay. I mean,
As you pay.
Yeah, as you pay. So, yeah, your payments, it's a good question. So if I had an insurance policy that I was able to use, you know, pay half or have a balance, that would not necessarily be amortized or allocated on the same basis as the expense.
And if with the line of credit they're charging me interest on that, the interest charge would go into the expense area as well? Like,
Right.
Okay, so the equation would be a little different. I'd be adding like
Yeah.
$20 a month.
That's right.
Because of the
That's right. Yeah, depends on the numbers, but sure. I mean, if the interest charge is $20 a month, that would be added onto your expenses. Whether or not it's significant enough to break it out as insurance expense or interest expense, you know, it's up to the company, but technically it's interest. If you finance that interest. And again, you wouldn't have the cash flow here, you'd have a liability until it was paid off.
And then when it's paid off, you take that cash out of the assets.
That's right. Cash goes down on the assets, and the liability goes down on the liabilities when it's paid. Okay? So, again, good questions, and keep thinking. I mean, you can actually make up your own questions kind of in that sense and answer them. It's a good exercise as well. All right, so one more to go. And before we do that, any other questions on this last event? All right, here's the last one. And it's just a straight up rent payment. So let me just be complete and finish this one with you. Check this on the side. So we've got rent expense or cash. Cash goes down. Rent expense goes up. And of course, that's going to reduce net income. As a secondary effect, and it reduces retained earnings. And that's how the balance sheet is balanced. But again, these are secondary effects. Now we have to think about the bookkeeping is simply rent expense and cash. Rent expense goes up, which reduces net income, and the expense is going to be the reduction, net income, and retained earnings. And of course, cash goes down. All right, so that takes us through the cycle. And of course, the mandatory slide that you can't read is right there. All right. And they had one of those yesterday, right, in the presentation? Here's our organization. It's like, all right, but anyway, we all do it. That's why I do it. I want to be, like the guys playing in the business world. All right, but anyway, if you could see this, you won't. When you look at it online, but the effects of these transactions is that the total revenues are $5,300, total expenses are $4,240, and net income is $1,060. And again, the change in retained earnings, you didn't have a beginning retained earnings, so this, the change in retained earnings is exactly equal. So let me just make sure I put this here for discussion purposes. Yeah, I don't know why this is included in the book. I didn't make this one up, so can't take credit for it. All right, so the net income in this case is $1,060. Out of all those transactions, revenues are 53, expenses are 42. And retained earnings go up by 1,060. And of course, the other accounts, if they would have subtotaled them, would have balanced as well. what I wanted to show you though, if you go down the cash column, if you added up this cash column, cash went up by 5340, and I'm just going to hold that number for a second. That's the increase in cash. Again, you're not going to be recording transactions like this much longer, but it is a summary, and again, you can see how impractical it would be if you actually use something like this to record transactions. You really can't do that. All right, now, if this was our only device to be used for transactions, you'd be able to pick these numbers up, and this is what a formal income statement would look like. So it's the name of the company, the title of the statement, it's for the month ended, like I said, it's like the moving picture. Revenues are, and even though, by the way, you've got the basic equation showing us revenues and expenses, a lot of subtotals are needed for information. So sales are going to be 5,300, cost of goods sold is 1,300. And if you remember some of the transactions, that represents the two transactions where they sold the inventory, once for 600, once for 700. That's how you get the 13. Again, we're going to dig into this a little bit more. But the gross profit is $4,000. And again, that is a critical measure. You want to look at your cost of goods sold. Gross profit is helping us understand how much profit remains, how much of those sales dollars remain, how much of sales dollars remains to cover your operating expenses. And we saw the wage expense, the rent, and the advertising. We didn't have, again, you didn't have operating, this is for the month of May, so therefore you have no expense on that insurance. I just want to make sure that's clear. You had zero expense on the insurance because we didn't move into the month of June yet. So this is only as of the month of May. So right now, that insurance does not show up as an expense. All right, so any questions at this point on the effect of expenses on the transaction equation on the template? Anything else on the income statement? Okay, so we start at the balance sheet, income statement, anything?